Today I'm going to be talking to you about 5 exit strategies that will change the way you trade. I honestly feel they will, because these are things that I've learned from the trading floor. As Renee said earlier, I started my career on the trading floor of the Pacific Stock Exchange. And I have an educational company, and there isn't a day where a student or a member or prospective member will contact me and say, Steve, you know, I'm happy with the way I'm trading. I'm happy with the current strategy or method I have. It's just my exit strategy that really needs a little work. Either I get out too early, or I get out too late and I watch a profit just dissolve into nothing, or I have a nice profit. I get out and I see that it could have been a tremendous profit had I only stayed in a little bit longer. Well, I think I'm going to be sharing with you 5 things today that will really help alleviate that problem. For example, if we look at this first chart right here in Apple. Now, you're going to become really familiar with this chart today because we're just going to focus on this. Now, let's say you had looked at this stock and your strategy, whatever it is, in fact, one of my strategies actually generated a buy signal right here. So you get into the trade and you decide to get out roughly around right here. You've got a nice trade in a couple of weeks. You made some good money. It was a nice trade. And so you get out. And then this happens. Okay, does it look familiar to anyone? Well, I'm going to show you a technique today. In fact, several techniques today where you could have actually exited right here, fairly close to the top of that nice little trend run before the trend changed. So once again, this promises to be a great presentation. I'm going to share with you all of the rules, all of the techniques, all of everything included in these 5 strategies. So welcome once again. My name is Stephen Primo. I'm the president and founder of Specialist Trading. Now, I teamed up about 8 years ago with Pro Trader Strategies, where we just simply educate all of our students. And actually, the numbers have changed a little bit in over 110 countries now around the world, and in virtually every state in the United States, where we're just strictly an educational company, because it's our philosophy to put the power back in your hands. I've been trading that now actually 40 years, and I have found there's one thing I've learned in my 40 years of trading. It's that it's a recipe for disaster when you take yourself out of the game. And what do I mean by taking yourself out of the game? Well, by relying on someone or something else to make your trading decisions for you. You see, I've been around long enough to see that that really doesn't work. Sure, everyone can have the master system or the master plan or you know, the master signals provided on a nightly basis, but you have to be a part of the process. You have to be able to make your own decisions. That's what separates you from a consistent trader to some trader that makes money for a little bit and then gives it all back. Now, as Renee stated, I started my career on the floor of the Pacific Stock Exchange. I've been actually trading now for 40 years. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. Now, if you're not familiar with what a specialist was, that's where we get the name specialist trading. It doesn't mean that you were any more special than anyone else. It just means that you made a market in roughly about 50 or 60 stocks. So if anyone wanted to buy or sell a particular equity, you had to go to the trader who specialized in that market and who made the market for you, who bought and sold. So if you wanted to, I used to trade IBM, I traded Waste Management. If you wanted to buy or sell any of those stocks, you had to go up to me and I made the market, and you either bought or sold the amount of stock from me. Now, I traded through the crash of 1987, the bull market that followed. So I traded in just about every market environment you can think of. I've traded every system, every strategy, every technique you can think of. So I know what works in my 40 years in terms of consistency, and I know what doesn't. So this is what we do, once again, as an educational company with Pro Trader Strategies and Specialist Trading. We simply mentor and teach all of our students around the world the things that I have seen that have a certain level of consistency in the last 4 decades I've been trading. These are things that I also use in my own personal trading on a daily basis. Now, this promises to be a great presentation. I'm going to give you the complete rules to all these exit strategies. You can decide which one you want to use, and you can start using them as early as Monday. But before we continue, we're required to show you this, so please take a moment to view our disclaimer. I'm going to show you a lot of performance results using these particular strategies, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated. Once again, we're required by law to show you that first before we begin. And as you're taking a brief moment to view our disclaimer, I would also like to take this time to invite each and every one of you to follow us on Twitter. There's our handle right there. You may want to copy that down. Every day I post new information on a daily basis, anywhere from signals that our strategies have generated to little bits of wisdom along the way. So feel free to follow us on Twitter. Lots of great information on a daily basis there. Now, once again, before we begin, I just want to reiterate that we are first and foremost an educational company. It's not in any way our philosophy or concept to force feed you signals, to force feed you and tell you what the perfect market is, to tell you what the perfect time frame is. We want to leave that up to you. What we do is provide you with consistent methods and benchmarks of strategies that have shown to have worked over time. And then we work with you and mentor you to meet your needs. So if you like to trade them more aggressively, we show you how to do that. If you like to trade more conservatively, we show you how to do that. You want to use a different entry point, a different exit point, we show you all the ways in which to do that. So that ultimately, you'll use the basic framework, but then work out from there so that you feel comfortable making your own decisions. So as you see here, my goal is not to force feed you signals. My goal is not to tell you what to buy or sell on a nightly basis. My goal is to teach you how to trade with the specialist edge. It's the same edge that was taught to me some 40 years ago when I was struggling, and what I really believe has been able to sustain me for the last 4 decades. Okay, so this promises to be a great presentation. I'm going to go through all the different strategies right now, and the only thing I'd like to say before we begin is that if you have a question, please wait till the very end to ask any questions. I know a lot of you may come up with questions, but I have to open up the question and answer box, and I'm going to leave that closed till the very end, okay? So if you have a question, just kindly wait. I promise I'll get to it at the very end. If we stop for every slide to answer every question, this short next half hour may turn into 5 hours. I can't do that because there's a lot of great speakers following me. So let's wait till the very end. It'll be just roughly in about half an hour or maybe even less than that. Okay, so let's begin. We're going to talk about the 5 exit strategies, and we're going to be using this one chart, Apple. And trust me, these strategies can be applied to any market, any time frame, in any direction. So it doesn't really necessarily mean that you have to be a stock trader. You can trade the Forex markets using these. You can trade intraday currency pairs, intraday futures markets. It doesn't matter at all. You can be going short on these. Just for educational purposes, we'll just be applying this one chart so that you understand the concepts, okay? And remember, these strategies are not designed to get you out at the top and get you in at the bottom. So there's different motivation behind each and every one of them. We just want to give you different options so you can decide what works best for you, okay? All right, so let's start with exit strategy number 1, and that's range extension. A lot of people aren't really familiar with this, so let me go into detail exactly by sharing with you on this particular Apple chart. All right, so once again, there is our buy signal right there. And in all fact, that was an actual buy signal using one of our strategies. So you want to go long, but where do you exit? You're not happy with your current exit plan. All right, so whatever strategy you are trading, it doesn't matter if it's one of mine, one of yours, from another educator, it makes no difference. But whenever all the rules come together, whenever all the requirements have been met, that is called your strategy setup day or signal bar, okay? Now, it could be if you're trading 5-minute bars and all the rules are met on a certain 5-minute bar, well, that's your signal bar. In this case, it's the bar right here where the buy signal was generated, okay? This is our signal bar. So once again, this could be a weekly bar, a tick bar, a daily bar, or an hourly bar. It makes no difference. But whatever the bar falls on, where all the rules and requirements are met, what you want to do is measure the range from top to bottom. And so we have candles here. And we're not talking about range from open to close. For some reason, people think that's what the range is. That's just the range of the body. We're talking about the range from the top of the wick to the bottom of the wick. You want to measure that, however amount of points, however amount of pips that is, and that is your 100% range, all right? So all you want to do is simply take that amount of points, in this case, because we're looking at a stock, and double it, and that will give you your 200% exit range, okay? It's that simple. It's just the amount of points of the setup bar, and you double it. Now, this is usually applied for people who like to trade in and out. They want to get in and out quickly. They don't want to hold positions a long time, and they don't mind a roughly 1-to-1 risk-reward ratio. They simply want to get in and out, and they're happy with their strategy, and they're fine just taking a quick profit, okay? Nothing wrong with that. Let's say you like to stay in a little bit longer. Let's say you like a better risk-reward ratio. You take the same amount of points of the signal bar, however amount it was, here's 200, and now you simply add that again on top of the 200% range, and this will give you the 300% exit, okay? So now you're basically risking 1 to make 2, a better risk-reward ratio, all right? So what a lot of people like to do is they'll say, well, Steve, once we get up to the 200 point, I'll sell a little bit here, and I'll sell a little bit here, okay? Nothing wrong with that, perfectly fine. Remember, there is nothing wrong. The only thing that's wrong is when someone someone tells you where to exit. It's up to you to decide where you want, because that's how you become consistent, because you're part of the process. You feel comfortable with your own decisions. Now, if you want to go for more bang for your buck, you simply take the same amount of points, whatever the setup bar was, add it one more time on top of 300, and that will give you the 400% range extension right here. A lot of students who like to get as much bang for the buck and like to get the best risk-reward ratio, 1 to 3, just simply exit everything at the 400% level, okay? Now, there are numerous ways to trade this. You could trade a little bit here, and ultimately get out of everything here. What some traders do is they say, well, Steve, I entered roughly around here on the close. Once we get up to the 200, I'll simply move my stop wherever it was. If it were here or right below here, I'll move it to unchanged. Okay, so I still haven't sold anything. And once it gets up to the 300%, well, then I'll move it to the 200%. So at least I'm locked in. And then once it gets up to 400, I'll keep doing that, so forth and so forth. Nothing wrong with that. Or, like I said, you can take a little bit and sell partial here, partial here, partial here. There's absolutely nothing wrong. The only suggestion we would make, especially while you're doing this in the beginning, is to exit the entire position at the 400% exit point. Because we have seen in the past, there's no statistics to prove this because we're not a statistical company. We're simply educating you on things that have shown consistency. We have seen over the past, and a lot of our members have told us, that oftentimes the trend will change at the 400% range extension. So you don't want to be stuck with a winning trade that now turned into a losing trade, all right? As you see here, see how the trend changed there. So, you know, however way you want to apply this, the best thing we would say in the beginning is to exit everything at 400, all right? Now, we have students that trade 600, 700, 800% range extension. That's fine. But they've been trading for a while, and they know their risk parameters, and they know how much account size they have, and they know how to raise their stops. So it's totally up to them. But that's the very first one. We use this in a number of our strategies. This is our go-to exit, and it works very well. And remember, we're looking at daily bars here. It would make no difference if we were looking at a 500 tick bar chart. Whatever bar where all the requirements are met, where the strategy, you know, it can even be based off news. Whenever you find that the news event, let's say earnings come out after the close, you're a trader that likes to look at news, and earnings come out after the close, you say, you know what? That's very bullish. I'm going to buy this stock. I've been waiting for it. Well, that's your setup bar, that what happened that day, okay? If you're looking at some type of indicator and it falls on a 5-minute chart, well, that's your setup bar where it told you to go long and go short. So it makes no difference, and it makes no difference if we're trading futures, currency pairs, commodities. It can apply to all markets. Okay, that was range extension, exit strategy number 1. Let's move on to the next one. This is pivot highs and pivot lows. Very common. I'm sure a lot of you have heard of this before, but for those of you who aren't familiar, let's do a brief refresher course, okay? Now we're looking for a 3-bar pattern. In this case, we're looking at a short-term pivot high. So all that says is that bar number 1 will make a high, as you see here. Bar number 2 makes a higher high, and bar number 3 makes a lower high. Now in this ideal scenario, as you see right here, it's very in sync with each other. You create this type of arrowhead approach, as you can see here. We're looking for short-term pivot highs, this 3-bar pattern, as the market is in a downtrend. So you want to apply these when the market's in a downtrend. Before I explain to you exactly how to apply them, you're looking for the pivot high, that type of an arrowhead approach, while you're in a downtrend. Now remember, in Apple, in that chart, we were in an uptrend. You had bought, so you were expecting the market to go higher in an uptrend. So in that case, we're looking for a short-term pivot low. It's the same thing, just reversed. It's a 3-bar pattern. Bar number 1 makes a low. Bar number 2 makes a lower low. And bar number 3 makes a higher low. So now you've created, in this ideal scenario, a type of V approach, as you can see there. We're going to be looking for short-term pivot lows, this 3-bar pattern, as the market ascends in an uptrend. So you apply these in uptrends. So since we're long Apple, we're going to apply this short-term pivot low. Now remember, if you shorted a stock, you would be looking for a short-term pivot high. All right, so let's look at Apple again. There's our buy signal. We're going to be using the same scenario on each exit strategy to show you how it works. And remember, these are not designed to get you out at the top. It just had a really nice exit there with the range extension. But we may get an entirely different exit here using the pivot lows and pivot highs. All right, so this is how this works. What you're looking for is that 3-bar pattern. And since we are in an uptrend, you're looking for the pivot low. All right, so what we have here is a pivot low. Bar number 1 makes a low. bar number 2 makes a lower low, and bar number 3 makes a higher low. So we've created this type of V approach, okay? So this is our first short-term pivot low. So once we've created that, that's where you place your stop, just below that pivot low or that V. Now remember, it's up to you where you decide to place it. If you want to place it 1 tick below, we have some members that place it 1 tick below. We have members that place it 5 ticks below. We have members that place it a full point below. There is no right or wrong placement. Remember, our credo, our philosophy is you make the decision. We're not going to sit here and tell you it has to exactly be here. That would be a disservice, and that, in my opinion, is a recipe for disaster. It's up to you to do the research, paper trade, and decide what works best for you, because that's how you become a consistent trader. This is what a mentor does. He doesn't trade for you. He teaches you how to trade. Okay, so that's your first stop level right there. All right, so now the stock continues to go higher. So we're feeling pretty good about ourselves, and we look for the next one. Now, I know it's a little difficult to see here, but we have one right here. We have a low, followed by a lower low, and this is just increments higher. So we have a V approach here. So you would place your stop just below that. Now, depending upon where you wanted to place your stop, if it was a tight one, the way this one is right here, well, guess what? You're stopped out. You would have exited. And this wouldn't have got you at a higher price level, but at least you had a nice profit. So do you see how these are all different? These are not designed to get you in at the top or bottom, and they're all going to be have different results as well. Sometimes it may get you out earlier. Sometimes it may prove to keep you in much longer. But that's the way pivot highs and pivot lows work. Very simple, very basic. It's been around for a long time, and in these strong upward or downward moves, it does not matter what time frame or what market, you can apply exit strategy number 2. Okay, let's go to exit strategy number 3, which is probably the simplest of all the 5, and that's the 9-period exponential moving average, okay? So all you want to do, as we look at our example here once again, is simply once you enter the trade, you apply the 9-period exponential moving average. That's it. And this is going to tell you where to place your stop and, if you want, where to exit. So how does this work? All right, so we're going to be looking for the very first close, not the very first time we touch the moving average, but the very first time we close below the moving average. That's where we have a choice. We can either exit or we can place a stop just below there, just like the pivot low. All right, so as we enter into the trade roughly right here, we see we have a nice run up and then we start to pull back. And these two bars actually touched. In fact, this one went below. Now, this is where most beginning students make the mistake. They think, well, Steve, I exited and it went right back up. Remember, we are looking for a close below there, and these did not close. So you have to wait till when the bar closes. So since the bar did not close, there's nothing to do yet. So we continue to track and to monitor until we get our first close, which hasn't come yet. In fact, we have another which closed right on it. And then we have a bar that opened below it, but look where we closed. We closed higher. Now, if you had taken the open and you would have exited, you would have missed a nice profit at the end of the day. So we're getting closer. We're still touching and closing right on it or right above it, but we have not closed below. And we do not close below and meet the requirement until right here. This is our first close below, so we have a choice. We can either exit at the market. It's up to you. Remember, the choice is yours, or when that first bar that closes below, you place a stop just below it. All right, this is where you're putting the power in your hands. You're not relying on someone to tell you where to get out. You're deciding. Now, had you exited where the market closed, that's okay. You would have had a very nice profit. But had you place your stop here, well, look what happened in the next week. We went even higher, okay? But ultimately, what did we do again? We start to close. So this is a sign telling you that the market's kind of running out of gas, because now here's our second close. We went all this time without closing below, and now we close below. So you can either exit here at the close or place a stop just below there. It's up to you once again. Either way, you would have been out of this trade, because look what happened on the very next bar, okay? So this is a great way to trade. Very simple, not complicated at all. The only thing to remember are just two things. We have to wait. If we're long, we wait for the first close below that 9-period exponential moving average. Now, here's the second caveat, and this is just a suggestion, but we found over time, you want to give this trade a little bit of room to grow. You don't want to use the very first or second bar to make your decision for you, because we've seen that sometimes, it didn't in this example, but sometimes you enter and the very next bar I'm sure you've all seen this before, it goes straight down. Now, had you applied that to the very next bar, you would have exited probably at that bar and said, you know what, this is a bad trade, I'm getting out. And then it would go right back up, right? So give it at least 3 to 5 bars before you apply this technique, okay? Because maybe sometimes, you know, you get these rash of sellers that will, you know, change everything, and you think like, oh boy, this doesn't work. But you need to give it a little bit of room to grow. All right, that was exit strategy number 3. Let's get a little bit more complicated here, a little bit more advanced. We're going to be moving into some more advanced indicators, and we're going to use number 4 is going to be based on the slow stochastic. Now, this is a very common tool. It's found on just about every charting software package. Don't ask me to go into the inner workings of it because I couldn't if you asked me, but it's just a very common overbought, oversold oscillator that you can find on just about any charting software package. Here's what we're going to do. We're going to edit the settings a bit, all right? Now, the slow stochastic settings on your software are usually set at 14. Once again, don't ask me to explain what this means. It basically just means that whatever the stochastics are based upon, it looks back 14 bars to come up with its calculation, okay? So what we're going to do is speed that up a bit. We're going to change it from 14 to 5. Now, this should be fairly simple. You just go to the edit box of your indicator page, and wherever you see 14, just change it to 5. If you're having difficulty with it, contact your tech support at your charting software, and they should be able to do it for you very easily or show you how to do it, okay? But you're going to just change it from 14 to 5, and you can, you know, always go back and forth, whatever you'd like. Now, why are we doing that? Because once we change it to 5, instead of this kind of slow rounding movement we have on the stochastic indicator, we're going to have a more jagged look to it, and that's what we want, all right? Why do we want that? Because we're going to be looking for a short-term pivot low again, but this time we're going to be looking for this pivot low in the indicator. So it's going to be the same concept, 3-bar pattern. We make a low, we make a lower low, and then a higher low, creating this type of a V approach. Once again, this is only applied if you're long. Obviously, if you're short, you're looking for the short-term pivot highs. Let me show you how to apply this here. All right, here's our friendly Apple chart, the same one. That's why I didn't want to change charts, because I just want to show you the concepts of the exit strategies rather than the actual markets we're trading. It can be applied to any market, any time frame. Since we're long, we're looking for these type of V approach here, right? In the indicator, and this blue line is the slow stochastic, the 5-period slow stochastic. So here's the very first one we have. We make this type of V. So what we want to do is find the low of that and the first up move in that stochastic and find the corresponding bars, okay? So you just see, well, here was the low, here's the first up move that create that V, and here are the 2 bars that correspond with that. Of these 2, since we're long, which is the lowest? Well, it's obviously the first one. So that's where you place your stop below, okay? See how simple it is? And someone can say, well, see, this is just like the pivot high, pivot lows. Actually, it's not, because we're basing, you'll see in just a few moments here where you're going to get entirely different signals. We're basing this not off the stock chart or the futures chart or commodities chart, whatever you're trading. We're basing our stop placement off of an indicator, entirely different, okay? So you place your stop there, which just happens to coincide with a short-term pivot low. And now you follow the indicator. We're looking, and it does not matter where on the indicator we have one created, but we have another one created right here, okay, another V. So we take where the low was and then the first up move, find the corresponding bars, and between these 2 bars and the stock, which is the lowest, well, it's bar number 2, so we're placing our stop just below there, okay? Now you see this is not the same as using the short-term pivot low for the stop, because remember, we had gotten stopped out right here on this short-term pivot low. But using this strategy, we bypassed that and didn't get to place our stop until here. So it kept us in the trade longer, all right? So now our stop is right here. Remember, it's up to you where you decide to place it, 1 tick below or 1 point or 5 points, up to you. We continue to monitor the indicator again, and now we form this short-term pivot low again, all right? So we find the bottom, the first upward move, we find the 2 bars they correspond to, and they're right here, this bar and this bar. And you see, had we just seen these 2 bars here, we haven't created these yet, there's no short-term pivot low at all. In fact, the short-term pivot low is back here. But you're going to place your stop below the lowest one, which is right here, which is actually a little bit higher than a short-term pivot low based off of the stop. So your stop is right here. And you just continue to monitor this until ultimately you're stopped out. This is different from the pivot lows and pivot highs we use that are based off of the stock movement. Now we've kind of advanced it and we're basing it entirely off of what an indicator is telling us, okay? So a little bit different. Remember, it does not matter where these short-term pivot lows are created. For in this ideal example, they were all created in the same, roughly the same spot, which makes you think that, well, we're looking for them to be created down here. But it could just as easily be a short-term pivot low created very up towards the very high of the indicator. It makes no difference. All you're looking for is that V, wherever it is displayed on the 5-period stochastic, okay? Okay, that was exit strategy number 4. Now let's get to our last one, which is also based off of a very common indicator, and that's the Dontoh channels. This is another very common tool that's found on a lot of charting software packages. If you're not able to access it, if you don't have it on your particular charting software, contact them. They may have it available, or you can do a Google search. I know we have no affiliation with this company, but I know freestockcharts.com. That's freestockcharts.com offers Dontoh channels. They're a free platform on the web which offers them, and so you can go to them if you don't have access to them. So how are we going to apply the Dontoh channels? Well, the Dontoh channels are similar to Keltner. They're similar to Bollinger Bands. They're a 3-bar type of channeling tool, and they're usually set at 21 as that default setting. So once again, that just means that the indicator, whatever it's based off of, looks back 21 bars to come up with its calculation. Once again, we're going to change things a bit. We're going to speed it up and go down to 9. All right. So just go to your your indicator settings, wherever you see 21, some of them may say 20, but wherever you see that, the length or the default, change it to read 9. If you have trouble with it, contact your tech support or go to freestockcharts.com. We have no affiliation with them, but I know some of our students have told us about this free site on the internet. All right, so let's look at what the Dontoh channels look at. We'll look at our old friend Apple once again, and once you apply the Dontohs, you'll have a 3-bar indicator, and it's very different from Bollinger Bands. A lot of people say, well, Steve, can't I just apply this for Bollinger Bands? No, because they're different in the sense that even though they're all going in the same upward direction, they're going more in a stair step or more of a jagged type approach. And they're not all in sync. As you see here, this top Dontoh channel is going sideways, where the bottom two, the medium and the bottom one, are going sideways to higher, and this one's going higher. Now, someone would say, so how do we know they're in sync? Well, because they're all headed in the same direction. Even if they stop at a certain level, where was their previous setting? Well, it was lower. So that means they're coming from a lower place, meaning that they're rising. So they don't have to all be in sync, as you can see here. Here we're going sideways, where these upper two are going higher. But they're all coming from a lower setting, so they're all in the same upward direction. That's what you want. And why do we want that? Because with the 9-period setting, it's simply telling us that we are in a full-fledged short-term uptrend. That's it. And we're not going to play stops anymore. We're just going to use this for an exit point. And you can apply this with any of our other strategies, but once you see either 1 or 2 of these channels out of sync, that's your clue to exit the trade. So for example, we see here that we're going higher, even though they're not all in sync, but they're all, going in an upward direction. Everything's fine here until this point. The top bar remains going higher, but look what happened to the median and the lower one. They went lower. So now they're totally out of sync. 1 is going higher, 2 are going lower. That's the market. Not some guy in a chat room, not some trading guru, but the market telling you the trend may be changing. You may want to exit part of your position, maybe the whole thing. Maybe you want to raise a stop up. Either way, you should start to look at this as the trend getting ready to change, because as you can see, if you exited right here, well, you would have managed to save some of your profit. Okay? So this is a very simple tool. We really don't use this for managing any type of stop placement. We really use it for just telling us whether to stay in the trade or get out. And you can apply it with any of the other strategies we talked about. So as we get ready to go to conclude here and to ask questions, let's review first of all. Remember, these 5 exit strategies are not designed to get you out at the top or out at the bottom if you're short. They're not designed for that. They're simply different methods to fit your personality, because as your mentor, we're trying to give you all these different options, things that have shown high levels of consistency, and we try to explain them to you, and then it's up to you to decide what works best. It's in no way in your best interest for me to say, you have to use this one. This is the way it works. Because I'm taking you out of the game. And what type of a mentor would I be if I've taken you out of the game? You're simply a spectator. That's not what trading should be. You should be a part of the process. So we provide you with this information. All right, our first exit strategy was the range extension. Wherever all the requirements are met, that's called your setup bar, regardless of what strategy or technique you're trading, regardless of what time frame. When the rules all come together, that's your setup bar. You simply measure the range from extreme high to extreme low, amount of pips, amount of points, and that you can just simply double that. That's 200, and you can exit there. Double it again, that's 300, and add it again, that's 400. We just suggest exiting everything at the 400% range extension. Next one was pivot highs, pivot lows, a 3-bar pattern. Okay, you look for that on the actual thing you're trading. As the market is going higher, you're looking for pivot lows because that's where you're going to place your stop below. If you're short and the market's going lower, you're looking for pivot highs and you're going to place your stop just above there. Where you decide is entirely up to you. Number 3 is the simplest of all. It's the 9-period exponential moving average. All you do is once you're in the trade, add the 9-period exponential moving average. And if you're long, the first close gives you a choice. You can either exit at the market or you can place a stop just below there. But it must be a close below there. Just because during the day we traded below there does not mean you have to exit. It must close below there. I showed you tons of examples where we went below there intraday and then closed above. Okay. The only caveat is we would say give yourself 3 to 5 bars room before applying this, because many times on the first or second bar after entry, if you use this, you would get stopped out prematurely. Exit strategy number 4, the slow stochastic. We're going to edit those settings from the standard default setting of 14. We're going to change it to read 5. And we want to make those jagged moves in the short-term pivot highs and pivot lows that are created not in the stock, but in the indicator. That's going to tell us where to place our stop based off the corresponding bars. And then lastly, the Dontoh Generals. Once again, a setting change. The standard default is 21. We're changing it to read 9, all right? And this really doesn't tell us a lot about where we place our stops. It simply tells us that the trend is most likely to change if 1 or 2 of the bars are out of sync with all 3. That tells you most likely the trend is over, get out, or at least raise your stop, okay? Now, remember, I just showed you one example because I really, as your mentor, as your teacher for today, I want to make sure you understand the concepts. That's why I didn't show you a ton of charts, because oftentimes students I found over the years get too confused on the charts or the time frame or don't understand it. So I just want you really to understand the concept. But this can be just as easily applied to E-mini trading. Let's show you a 5-minute chart. This was an actual signal generated by one of our strategies, okay? Let's say you wanted to use the range extension. Now, in this case, you're short. Well, this is the setup bar. This is the bar where all the requirements were met. So it does not matter that we're looking at a 5-minute bar. It does not matter that we're looking at an E-mini market. We apply the same rules. We measure from top to bottom. That's 100%. And we can simply pinpoint the different levels we want to exit. If we want to get in and out really quickly, we exit and cover our short at 200 or 300 or 400. It's all up to us. And as you can see, we went right down to those levels. Now, our only suggestion is always get out of your position in the beginning while you're learning this strategy at the 400, because many times the trend will change and you don't want to miss and turn a really nice winning trade into a losing trade. Or how about the Forex markets? Okay, let's look at a weekly chart of the Canadian dollar. Here's an older chart, but we have a long signal. Once again, one of our strategies generated a buy signal here, and we apply the 9-period exponential moving average. Now, as I stated, these strategies are not designed to get you out at the top, because someone would say, well, Steve, why didn't it get me out here? Well, in this particular case, it still had you in the market. But here's our first close below, all right? So you can have a choice. You can either exit right there or place your stop below. Does not matter, because either one would have been a good exit, as you can see. So here's what we talked about, though. Here's a perfect example. Here was our setup bar. And look what happened on the very next week. We closed below. Now, had you not waited and given this trade enough time to, to weed out all of the noise after your entry, you would have exited right on this first setup here. And that would have been the wrong thing to do. So that's why we say give it anywhere from 3 to 5 bars before you start applying this technique where you wait for a close below, okay? All right, There you have it. 5 exit strategies that will change the way you trade. My only suggestion is for all of you is to paper trade this. You have all of these. I'm sure if you have questions, this presentation is being recorded. You can go over and look over the recording if you have a lot more questions or you didn't understand it and want to see the examples again. But as an educator, we're just simply trying to provide you with edges, trying to provide you with strategies that will help you. And this is just the tip of the iceberg of what we do at Specialist Trading and Pro Trader Strategies. So before we go into questions, I want to ask you a question. Do you think these edges could have helped your trading this past year? I mean, go back and look at your last 10, 20 trades, especially the ones you lost on. Do you think any of these exit strategies could have helped you? Could have helped you stay in the trade longer? Could have helped you move your stop while you're in the trade? I think your answer will be yes. So what if I could offer you 10, 20 more edges, things that will really help increase your odds for success? Well, here's our special discount for all the people attending Investors Inspiration Mastermind presentation today. We have a special offer. It's our Secrets of a Stock Exchange Specialist training sessions. Now, about 3 or 4 years ago, I was asked to be the head speaker at a conference in Denver, Colorado. I spoke in front of hundreds of people that came to see me speak, and I spoke for 3 hours. And during my 3-hour conference, I talked about many more high probability trading edges, which indicators to use, but more importantly, which ones not to use. I talked about the difference between a system versus a strategy. I talked about the #1 chart pattern you should be looking for in virtually any method, regardless if it's one of mine or one of yours. So I gave a lot more information about things I've accumulated in my 4 decades of trading. But I think the most valuable thing in this 3-hour video seminar is that I gave the complete rules, not just the exits, but the complete rules: entries, exits, stop placement, money management, how to trade conservatively, how to trade aggressively, to one of our best pullback strategies, and that's strategy #1. Now, a few examples here. You can see if you're a member of our strategy #1 course, here was a perfect example in Halliburton. Most people would have looked at this chart and said, well, Steve, you know, the chat room I go to says that this is really not something you want to be buying, because look, we broke support here. And this is, you know, all the institutions are selling, and the volume, you know, is really bad on the downside. So I think this is a short. I'm going to look at this as something to sell. Well, remember, this is how most traders trade. They listen to outside sources. They're not a part of the process. They're listening to other things tell them what to do. What did strategy #1, which is based off what the market is telling you, not anyone else, what did strategy #1 generate? It generated a buy signal, okay? And had you taken that, well, look at the nice run up you had. This was just a pullback in an overall uptrend. Now this can work to the downside as well. Someone looking at this would say, well, Steve, this is a double bottom. All the institutions are buying here. The guy in the chat room I follow likes this, and I think I'm going to purchase this because it bounced perfectly off this Fibonacci support, and we're going to go much higher, okay? Once again, where are your decisions coming from? What other things or people are telling you? We only base our decisions off what the market is telling us. That's what our strategies are based off of, listening only to what the market tells you. The trouble is most traders never learn how to do that. Well, that's what I learned some 40 years ago on the floor. And the market was telling us that in all actuality, the overall trend was down, and this was actually a sell signal. So strategy #1 generated a sell signal, and look what happened the very next day after you could have gotten short, okay? And you can apply options to these. These work on futures, currency pairs, makes no difference. All of this is included in a 3-hour video seminar. Now, my sister site, Pro Trader Strategies, has this offered on their website for close to $1,000. That's how much information and how valuable this is. We're drastically discounting the price to all the people today down to only $37. You're going to get 3 hours. This is a link that is sent to you, so it's not something you have to wait that's being shipped to you or mailed to you. This is something you're going to get in an email immediately, and it's yours for life. It doesn't, you know, disintegrate in 2 weeks and then you can't follow it anymore. This is yours that you can have for life. You can look at these 3 hours of information that have taken me 40 years to accumulate. And you can always have in your back pocket, and you can always look at and refresh. Plus, you have all the rules to one of our best and complete strategies. That's why it's usually priced at such a high price, because you're getting a complete strategy in this. This is reduced from $9.97 down to $37. And one last thing I failed to mention, you're also getting mentoring correspondence with yours truly. So if for any reason you don't understand something or you need a question answered, you can always contact me via email, and I will answer any question you have, okay? So this is usually just reserved for members of our strict courses, but you're also included in that as well. So here's how to take advantage of that. Contact Pro Trader Strategies, my sister site. You can also call them directly. And as you see on the very bottom there, that's the link to signing up for the $37 deal. All you have to do is simply copy and paste that onto your browser, though, because that's not a live link. But if you're having difficulty doing that or copying and pasting that, all you have to do is contact Pro Trader Strategies. I think the best thing, probably call them. There's no obligation. You can ask them more questions, and they'll supply you with that $37 offer. Just tell them that you went to the Investor Inspiration Conference, and they'll supply you with that. But that's going for a limited time only. So, you know, don't take a lot of time wondering about, I mean, for $37, I can almost say that most of you probably spent more than that just in commission costs alone. I know that you can't go out to dinner these days with a spouse or a significant other or even a friend for less than $50 or $100. Sometimes even lunch costs $50, you know, a light lunch. So $37, you're getting a lifetime of information, and once again, yours truly as your mentor. So I have a couple of questions or minutes left before I have to sign off here. Let's see. Is this being recorded? Yes, it is. This is all being recorded, and you can check it out. But please remember if you know, you want to take your time, that price may go all the way back up. So, you know, $37 is not asking a lot. Okay. JV is asking, does the arrow indicator come with the $37? No, I'm sorry to say it doesn't. But remember, once you understand, our philosophy is not to force feed you buy and sell arrows, because that's a crutch. Most people will use that and they'll say, well, I don't need to learn anything. I'll just look at the buy and sell arrows. Remember, our job is to educate you. And most of our students, after a couple of weeks of studying, don't even need to look at that, okay? Let's see, people are saying charts tell you everything there is to do. Steve says, Steve Napity. Yes, they do, Steve. They tell you everything. And pretty much everything else is what my mentors call just noise, okay? So the link is right there at the bottom. I know a lot of people are asking. The link is at the very bottom. It's not live, but all you have to do is copy and paste that, and then you can paste it onto a browser and it'll take you there. But if you're having difficulty, just contact Pro Trader Strategies, the number included right there, and they will set you up with that $37 deal, okay? I think my time is just about up. I don't want to get in the way of the next presenter, so everyone stick around. There's going to be another great educational presenter for you. I want to thank Investors Inspiration for inviting me, and I look forward to all of you becoming students of mine at the Secrets of the Stock Exchange Specialist package, okay? Thank you so much. I hope you got something out of this, and I'll see you next time. Bye-bye.